All right, this is Ubaid on behalf of V Electronics, and in this video, we're going to be talking about ways the central banks impact money supply. Now, one of the ways the central banks impact money supply is through reserve requirements. Okay. So, this is basically telling the commercial banks that, hey, listen, you need to have so and so as part of your reserves, okay, which means they need to have a certain amount of money, whether that money is in the form of paper currency, gold, okay, precious metals, so on and so forth, in their vault at all times. Okay, this is to maintain some sort of a collateral, okay, in case they're not able to pay their short-term depositors, okay, demands on loan, okay, or loans on demand. All right, so basically this has to do with reserve requirements. And when it comes to reserve requirements, okay, basically what you're saying is, listen, you need to have 10% reserves for you to be able to, okay, continue working, okay, continue doing business. All right, so this is for the commercial banks. Okay, so the commercial banks, they need to have 10% for them to be able to continue doing business. Okay, so this would be an example of a reserve requirement. And one way, okay, the commercial banks can borrow money when it comes to reserve requirement is through overnight loans. Okay, and this has to do with your federal funds rate. So your federal funds rate has to do with commercial banks borrowing from each other. Okay, now you may have a certain bank that may have a lot of money in their reserves, so they may have additional or excess reserves, as a result of which they may decide to lend some of that money to another bank, which may be coming short of reserves. Okay, and this is the reason why we were talking about reserve requirements earlier, because a bank that has, let's say, more than 15%, okay, of their total assets in reserves, okay, may decide to give off 5% of their total assets, okay, to another bank that may need 5%, okay, to keep up with their minimum reserves. Okay, so this has to do with federal funds rate, the rate at which one bank borrows from another commercial bank, okay, in terms of meeting their reserve requirement, okay, via overnight loans, okay, so on and so forth. Okay, so the rate at which one commercial bank okay, borrows from another bank. All right, so this has to do with reserve requirement. Now, apart from this reserve requirement, okay, you also have, okay, your discount rate. Okay, this is your federal discount rate. And the way the federal discount rate works, okay, this is via money supplied by the central banks. Okay, so the central banks may supply money. Okay, as a result of which, okay, these banks okay, may need to have a certain type of reserve requirement, okay, which means, okay, they may impose a reserve requirement on the commercial bank, and then they may supply money, okay, via loans, okay, via short-term loans, for example. Okay, and this is one reason why these commercial banks, okay, will need to have certain amount of reserves. Okay, it's because the central bank regulates these commercial banks, okay, in terms of their reserve requirements. So when the central banks regulates the commercial banks, they also provide loan. Okay, and these are short-term loans, unlike overnight loans. Okay, and the rate at which this money is borrowed from the central bank is your federal discount rate. Okay, so that would be it for this video. On behalf of V Electronics, this is Ubaid. Have yourself a great